5, 4, 3, 2, 1.
Hello, everyone, and welcome to this very special edition of the EUVC Lowdown, where we unfortunately do not have Cathy White, our usual host, with us. So she left me to try and tackle the topic of VC secondaries in Europe and what's going on in the market. We're joined by Michel Geolier, founder and CEO of Betterfront, a platform for GPs and LPs to trade LP interest, and also a all-in-one fundraising software for VCs. Also joined by Alexandre Covello, founding partner of Paladin VC, a Web3 focused VC fund, and also a very seasoned veteran investor in in secondaries. And finally, Alberto Chalon, general partner of Giano Capital, a fund mainly investing in secondary transactions in growth stage VC companies. So with this introduction done, I will ask you, Michel, could you tell us exactly why you have chosen to build and launch a platform to trade LP interests in Europe right now?
Absolutely. Hi, everyone. Really good to be here with you today. So, what we have done at Betterfront for the last years has really been focused around primaries, right? Helping GPs raising their flagship fund. But over the years, what we have seen is really, a two-sided product. One hand, you have primary, on the second hand, you have the secondary aspect of managing a fund. And that part is really increasing. Not only do you have more and more secondaries of LP fund interests, in 21, we had $132 billion of LP fund interest being exchanged, and that's less than 2% of the entire NAV, right? So it's not really a lot, but it has been growing. And the reason for that is because, LPs, investors into funds, mostly individual family offices, need liquidity, whether it is for strategic reasons, for portfolio management reasons, for personal reasons. There's a lot of different reasons that have nothing to do with the GP, but really about the LP and maybe any change that they have in the way they want to invest. And so really we have seen that need for liquidity, which is really what Secondaries is all about. And, if you really want to trade any LP fund interest, it's very difficult. If it's not a large one, if we're not talking about 50 million, then basically you cannot access placement agents. It's because they really work only with big stake. So that's why really the liquidity of small to mid-size, LP fund interest has been limited. It's around 3% of the market today. So it's not a lot, again, because, it's very hard to have any sales. So what we have done today is we've launched that marketplace really to help not only LP selling, but also the GP stuck in the middle, right? I have an LP that I want to sell. How do I manage that? Because we also have heard from our customer, we have more and more of those LPs that want to sell. So how do we handle that kind of new job, right? So secondaries are increasing and it's only going to keep growing from there.
And I can only second that because, the part about if it's a small stake, then it's very difficult to sell. There's not a lot of buyers out there. I have spoken to multiple investors on the GP side and on the LP side that have been wanting to make those small trades, and it's not very easy to find a buyer that is sophisticated enough to be able to do it and still want to bother dealing with a 500k or 1 million euro transaction.
Exactly.
Alexandre, we've spoken about this before as well. I remember reaching out to you with one of such transactions saying, I know this guy who has this need. Is there someone in your network that would be interested? So I'd love to hear your take on this whole secondaries industry in Europe.
No, so you're right to say that trading small transactions is more difficult than trading larger ones. And there is also a difference in between trading private equity and growth assets. Or buyout assets than trading venture capital. And I think we are at some sort of an inflection point. Secondaries have been around for almost 20 to 30 years in PE, and they're now coming to venture capital. Why? Because there are we've created so many assets in VC over the last 15 years that it's becoming a larger or bigger enough market for the usual suspects in secondaries. So, the 10, 15 large funds to start looking at the asset class and buying some of those assets as well. We very much second what Michel has said. This is now a great momentum or a great time to be investing into secondaries. And I think for two reasons. There are some secular trends in secondaries where people or investors, LPs, large endowments and foundations have been selling their portfolios or reshuffling their LP stakes, mainly for distress reasons. This is not the case anymore, and people are really selling because they're using secondaries as a portfolio management tool. Now, I think there is also some sort of topical reasons why people are selling now. We are in a bear market, and people have some sort of like the famous denominator effect, which means that their exposure to private equity in general and venture capital in particular has become too big compared to their public equity exposure. And so there is a big trend for selling. But I'll stop here. I think one of the big issues here is the one that you mentioned, which is that it's difficult to find the right buyer for the right asset. So having a platform might help in some segments of the market. And then the other thing, which we may discuss later, is pricing and valuation. It's hard to find, to sell an asset at the right price to the right people.
Yeah, and maybe before going into those 2 points, which I think are incredibly interesting to try and tackle, Alberto, I'd love to ask you, because you come from the perspective of investing directly into secondary transactions in startups rather than funds. Would you tell us a bit about why you're seeing the why now for Giano Capital, which is the fund you're currently building?
Of course, the why now has been accelerated, as mentioned by Alexandre, by this market environment where exit are postponed on IPO, especially very rarely we have an M&A. So now in this moment, LPs needs cash. This is true, but I like also to highlight why the company should support secondaries, because when your employees or some of your founder or co-founder can get a small stake, a bit of liquidity, you can keep talent working here. This is one. Second, this trend will anyway start, because if you go and you see the American market, it's 5-10 years that this is going on. So it's just a quick acceleration. The point about the small or big transaction is that we always need the support of the company, because sophisticated buyer needs to make a due diligence. And personally, I think if you invest 500,000 from a family office in a secondary transaction of 5 million, a DD is deserved. So when we have access to this information, it's possible. So what I recommend is to have an ecosystem of sophisticated investors that can share under confidentiality some information and being then capable to trade secondary shares in the market. And Giano is here exactly at the heart of this strategies, being sophisticated investors, expert investors, and getting the trust from the seller and the buyer, and then take position under a fund.
Yeah, and I'm curious, Michel, because I'd maybe kick that to you, because you've been building the platform now, and I'm sure that you've had to tackle the question of, well, it's not just putting a logo, a size of the share being sold and the price. I'm sure that there's more that you have to facilitate between the buyer and seller.
Oh yeah, you cannot just be like an eBay and call it a day. There's way more. So a couple of things, and really building on what has been said so far. The first thing is you have to kind of standardize a transaction, because it's very difficult, especially if it's small. So one solution to that is to standardize with legal documentation, so e-signing and so on. So that's one part. But the other important part also, and that's something that has been quite important to us on the primary side, and it is as even more important on the secondary side, is using data analytics to help pricing decision, right? Because you're looking at a fund that has X assets between 20 to 100, and if not more, and a buyer that want to buy, let's say 500K or 1 million or 2 million cannot spend a week or two just looking at that asset. So we really have to bring all the data, the analytics to enable that due diligence at scale. If you are 20 billion secondary fund, you don't spend any time on a 1 million stake. Now you kind of can, because all the data is here ready for you to engage. The critical part that we are also seeing is, again, it's about the GP. So it's kind of three sides of this. There's a selling LP, there's a buyer, and then you have the GP, right? And here Alberto and Alex as GP, that in your LPA you have you've designed your own LPA, and you might have some restriction on it, like who can be the buyer, where can they be located, what are my preference, right? Can they maybe invest in my next fund as well? So all of those things you also try to build in the platform and the network of buyer to really make sure that the GP has a smooth process. We are clear with regard all the restrictions and the LPA and so on, that the transfer can actually happen, and the analytics behind to really make sure that the price that is being offered, very often the way that secondaries are done at that level is, what is the discount these days, right? Is it 50%? Is it 20%? Is it somewhere in the middle? The idea now is you can actually analyze and have more buyers, more informed buyers, and really have also a much better price as well. So that's a couple of things that we have seen around how would that transaction happen actually.
Alexandre, you were about before to also touch on pricing and terms, and I'd love to hear your take on this, both what Michel just said, but also in general what you're seeing in the market.
So I think I'd like to rebound as well on what Michel just said, but I'll get back to that later on. I think on pricing and valuations, which are two different things, there are different issues at stake today. So the one thing that, and I'll tag along to what Alberto just said, if you take secondaries on direct transactions, especially in ventures, which is the topic of today, people selling are mainly early first employees or founders that want to get liquidity, and you've been building those businesses for a long time. That liquidity is required. You cannot ask people to stay into companies without having proper compensation for more than 5 or 10 years. So I think the liquidity market is needed at I would say shareholders level. I think one thing I would like to say, I'd like to bring some technical point, which I think for me is very important, is that there is a big difference between the US and Europe. In the US, there is something that in Europe we don't have as of yet, which is the 409A valuation. So that's something that comes from the IRS, the tax man in the US, the IRS code, which basically asks any company that is issuing stock options plans to do evaluation on a yearly basis. A lot of people in the US will say, well, and you have to pay some sort of accountancy firm to get that valuation done. So a lot of people will challenge the fact that this is really a fair market value and it's not as good, that it's not really the proper valuation, but at least it's a better starting point when starting from the NAV. Because reported NAVs are not always, what you would expect. It was like Mark Benedetti, who's a US co-head of Arden, recently had a quote which I really like, which was like, not all NAVs are created equals. And I think, you have big issues on the way NAVs are reported. And so the question is like, what do you take as a price, as a base to come up with a price? It makes a big difference. So long story short, the 409A valuation in the US provides a base which is closer to fair market valuation. We don't have that in Europe. And so I think, putting prices on assets in Europe is even more difficult than in the US. With that said, so that's really on the valuation side. On the pricing side, it's a deal. I'm offering a price, you're selling, and there you have all the tension that always arises between sellers and buyers. And I think here I'll say two things. One is on the single assets. It's very hard to convince both parties, both sellers and the company, to agree on a very low valuation, because if you have a second transaction happening on an employee stocks, that probably also sends a message to what the company is really worth, and not probably the NAV that they're reporting with the last valuation round that they had. So that's on the single assets. On funds and more diversified portfolio. The real question we're facing today, and the last thing I'll say on market trends, is that, interestingly enough, people think that it's when there is a dislocation in the market that there is an opportunity to sell and buy. So that's not really the case. If you go back to March 2009, after the subprime crisis, or March 2020, when COVID hit, for a good 6 to 12 months, there were no transactions. And we're seeing the same thing today. There is a little number of transactions happening today because sellers are not willing to sell at a steep discount. Those transactions became huge, maybe 12 or 24 months after that, when NAVs went down and people could sell at the same price, but with lower discounts or lower facing discounts. So what I'm expecting, and I'll stop here, and I hope that also answers the question, is that we haven't seen as many transactions as expected over the last 12 months, or since we went into a bear market. But I'm quite confident that sometime H1 or H2 2024, the market will be very, very liquid. And so hopefully the people will be able to sell, buyers will make good deals, and platforms will be able to facilitate that flow.
I am very curious, Alberto, to bring you into this, because Alexandre just gave us the viewpoint of, okay, so where we're headed, we're going to see more liquidity, we're going to see more things happening. You have been building Giano through a period where secondaries were first done in, at markups everywhere, and now I'm sure that you're seeing quite a few secondaries being done at discounts. Where are you seeing the market heading going forward?
First of all, the market is following what is happening in the public market. So this is the first rule. So when it goes to valuation, in our opinion, has to be always linked to the public market or available and reliable source. And here I really agree with Alexandre saying that in the US, it's a little bit more clear. Having said that, there is another component which is super important and becoming extremely important now, is to have a very good understanding which are the share class you're buying and what is the liquidation preference and the constraint behind it. So again, here, what I suggest to LPs is either you have a structure, you have a knowledge, and of course, then this come with a ticket size that justify all this investment. And so then you can have direct secondary transaction, and the USP is there because you can target the best asset, as we do. Otherwise, the option 2 is to go with some funds, sophisticated GP that can have 2 things: access to information, knowledge to have understanding about the price, and having access to a due diligence that make this transaction happen. And on top of that, as an LP, you will have a correct diversification between us, because what we also have to remember is how much we want to go as an LP in this market and how much we're gonna diversify within this asset. So now looking at the market, I think it will stay still in this environment for the next, I would say, 18 to 24 months, because I do not see the public market going so much higher. It will be interesting because this is also linked to the interest, because as all we know, when people can have 3, 4, 5% risk-free, of course, public valuation decrease, and you can see this has been historically. And just to get one index, example, the SAS index, it's really consistent with the public market, because we all know that now we need to have better returns, so means lower valuation if we want to take this public equity companies, and we need more for having any liquid premium when it comes to private company where we do not have any visibilities on exit. So higher risk, and we need to target for higher return. So this, I think it's totally possible today to explain to sellers, and they are more ready to understand. So it's always a question to have the right arguments to explain evaluation.
And I want to ask a final question on visibility, Michel, because I know that there's nothing that GPs care more about in terms of their funds, which than making sure that all the information about their funds aren't out there. So how do you walk the thin line, I imagine that it is, between offering transparency and also at the same time making sure that you're not disclosing any information that shouldn't be there?
Yeah, that is really almost number one on the list for us. I mean, the thing which is clear from the discussion of today is if you're a GP like Alberto and Alex, secondary is coming from every angle, whether it is a portfolio company level where you can make secondary, you have to make investments, you have to trade some of those investments maybe, and then on your own fund level, right? You have to raise capital, you have maybe some liquidity event on the fund level as well now. So the job of a GP is really getting more complex, and we need a sophisticated platform to really handle all of that. So the need to have control of the information flow is critical here. The way that we do it for us is we have the GP almost the co-pilot of the transaction, in some cases even driving the transaction him or herself. So you can almost see it as a strategic tool for the GP to really say, okay, at year 2, at year 4, I'm going to have a liquidity event. I'm going to ask X% of my LP base if they want to sell, and then we can make two transactions happen in a bulk, so it even helps us in terms of pricing with buyer and so on. So it can really go up to that. But even in a single LP fund interest transaction of, 500K, even then the GP is on as a co-pilot, agreeing on things such as, the NDA, who has access to it, which region, what type of buyer, do they do also primary investment for my next fund, like I said before. And then, of course, having to agree on the transfer itself, right? So really having the GP as a co-pilot in that entire process, even though driving the process him or herself, is really how secondary on the fund level are going to happen. You cannot just have anybody shout on internet like, hey, I'm selling, here's the data. That would be worst case scenario. What we want to do is really offer a control environment, have the seller sell, get the liquidity he or she needs, have the buyer access that new segment, and of course having the GP in control of that without having to take a new job, right? Because that's kind of what it is. It's a new job, so really keep it a low maintenance on the GP as well.
I saw a week ago or so, 2 weeks ago, maybe an LP interest being shouted out on LinkedIn, and I was like surprised that that's okay with the GP, even though it was only said that it was high performing, blah, blah, blah. But, still I was surprised to see it, marketed like that. Alberto, in for a final comment, and then we need to round it off.
I think here we need to make all the stakeholders on the same side, which means we need to have the support, and this is our belief, of the companies in this transaction. This is very important. Without the support, we miss a lot of information. And not only what I mentioned before, which is the share class, the valuation, but we miss the information about the future. Because why we're investing in a company today at any given price is how we can make money. So the company and the management has to be aware about the transaction if we want, as an investor, to get an aware decision. This is one. To do that, we need to get the trust as operators, as GP, as LPs, as investors, that any of the information that will be shared will stay confidentially. So also us, as ecosystem of buyer, we need to get some traction, some track record where we'll be capable to manage sensitive information. I want to say sensitive because then the company, the risk is that, okay, you're gonna disclose something to their competitor. So we need to really get this habit and this use. I think we are almost there because the necessity will create these capabilities, but this is the direction we should go. And again, going through GPs and diversification and sophisticated investors that can do transaction at its big size can help a lot.
Gentlemen, it was amazing to be on this panel with one French person, two French and Italian citizens as well. So that is a rare mix. Thanks a million, gentlemen. It was awesome to have you on for this panel. Have a great end of week.
Thank you, James.
Thank you.